I'm constantly looking for dividend growth, but JEPI's distributions have been experiencing some shrinkage. After researching the factors that determine JEPI's distributions and its price, today we'll look at both and answer the question, what happened to JEPI? I bought JEPI in January 2023 when it was yielding over 11%, and since then the price has traded sideways while the S&P 500 took off. Not great, but if the distributions remain at 11% plus, then who cares? Unfortunately, that's not what happened. The distributions have dipped down to as low as 29 cents in August. If you annualize that number, it would equate to a yield of 6.3%, and that's not cool. Fortunately, September put an end to the downtrend at 34 cents, but it's still important to see what's going on and whether to continue holding JEPI. I wasn't the only one who bought JEPI this year. Their assets under management have grown to $29.3 billion with a B. That's 10 times bigger than the rival covered call fund XYLD and 100 times bigger than SPYI. I won't be explaining how JEPI works because this is an update video. For a full breakdown, including the pros and cons of JEPI, check out this video. Let's start with the price and why it's been drifting aimlessly in 2023 while the S&P 500 has taken off. Look at JEPI's total return in 2022. You might have forgotten, but almost everybody's portfolio, including mine, was deep in the red last year. JEPI was clearly doing its job, down just 3%, versus the market down 19%. I'd erased that from my memory. Back to 2023, and the change has been dramatic. Clearly, the S&P 500 was the better place to be in so far in 2023, at least in hindsight. I think it's worth pausing to remember that the stock market delivers an average return of about 8% per year. Which of these two investments is closer to that average? JEPI is almost there and it's only September, so in an average year, if that exists, JEPI looks almost normal and the S&P is the anomaly. Up 19% in just 8 months isn't normal. You've probably guessed that tech, or more specifically AI, has something to do with that. Remember FANG, F-A-A-N-G? If you remove Netflix, which fell from 690 down to 175, ouch. Can you imagine what it was like for the people who were all in on Netflix? Eesh. If you remove Netflix and add the 2023 AI poster child NVIDIA plus two stocks that benefit from AI, Microsoft and Tesla, you get a new list of tech darlings known as the Magnificent Seven. These 7 stocks don't just represent the powerhouse of tech earnings, they also make up the top 7 slots in the S&P 500. It's a market cap weighted index, the S&P 500, so they're driving the bus. 7 is only a 1.4% of 500, but because of the weighting, those 7 comprise 28% of the index. Compare that to the Magnificent Seven's contribution to JEPI, just 5.6%. We think of the NASDAQ as the tech index and the S&P 500 as the market, but increasingly the S&P 500 is behaving like a tech index. If we assume that the 500 companies in the S&P 500 represent the market, and we want to check the performance of all 500 companies, not just the heavily weighted ones at the top, we can use the S&P Equal Weight Index. Year to date for 2023, how do you think those 500 companies have performed? Not such a broad-based rally. In fact, JEPI has nosed ahead of those 500 companies in total returns. Most of the charts I'm using come from Seeking Alpha, but plenty of websites have charts, except for total returns. That one's a bit trickier to find. The charts are nice, but most of the value I get from Seeking Alpha is not the charts, it's the in-depth articles. And for this video, I read 8 of the most recent articles about JEPI, and I'll post a link to my favorite of the 8 in the description, along with a link to a free trial. I don't buy a stock or a fund without first checking it on Seeking Alpha. Let's get back to JEPI. The individual stocks are selected from the S&P 500 based on factors like consistent earnings because they're optimizing to minimize the downside during a sell-off. In other words, to avoid getting Netflixed. You might be thinking, who cares about volatility? If I'm a dividend investor, I'm not selling, I'm just collecting dividends. Well, the assets of the fund are what cover those covered calls, which means the smaller the fund, the fewer the calls that can be sold, and therefore the less income. In other words, you don't want the JEPI price to fall dramatically because it would reduce the distributions. So I think this boils down to how dependent you want to be on the Magnificent Seven stocks. They're all great companies and I want to have some exposure to them, But as a retiree, I want them to generate some income too, and funds like JEPQ deliver that solution, the sister fund to JEPI. In order to sleep well at night, I also need income that doesn't rely on those 7 companies, or for that matter, isn't deeply affected by any handful of companies. JEPI's portfolio of well over 100 stocks, none comprising more than 2%, give me that diversification. If Facebook disappoints on earnings and crashes 30%, I'm not losing any sleep. So that's the deal with JEPI's price. It underperforms the tech-heavy S&P 500 in a bull market, but the total return is about level with the overall market, and I'm okay with that. Before we dive into the dividends, a quick disclaimer: I'm not a financial advisor. Since retiring in 2017, I began researching my investments in far greater depth because they pay for everything. So when I find something interesting, I make a video. Let's look at those declining dividends. JEPI's a covered call strategy, so the dividends are determined by emotions, really, especially fear. JEPI sells call options on the S&P 500 index, and the value of those options is driven by the Volatility Index, also known as the Fear Index, or the VIX. It's a measure of expected volatility over the coming 12 months. In times of fear, the demand for buying options increases as investors use them to reduce their risk. Greed also plays a part. Options can be used to amplify gains when investors are particularly optimistic. Stronger emotions, fear, or greed mean higher dividends for covered call strategies like JEPI, and in 2023, the market has been about as emotional as the Terminator. Here's the VIX going back to 2005. You could spot the 2008 recession and the 2020 pandemic from a mile away. More recently, the VIX was elevated during 2022, when the war and inflation led to a lot of fear about the unknown. In 2023, the VIX has calmed down considerably, so option premiums have also come down. This chart shows the correlation between the VIX in blue and JEPI distributions, which are the green lines. You can see there's definitely a correlation. Looking at the JEPI distributions for 2023, and it felt like they were going to keep sliding down indefinitely. However, if we understand that they're a function of the VIX and the VIX is close to historic lows, it's not so concerning. The market can't stay this calm forever, and we saw the first sign of this in August when the VIX ticked up, and so did the JEPI dividend. Nobody knows when the next piece of bad news will cause the market to panic, but it will happen, and the JEPI dividend will benefit from it, which actually sounds a bit morbid when you think about it. Here's an interesting chart. It shows the historical VIX averages going back to 1990. There's a pattern of seasonality that points to a higher VIX in the later months of the year, which is what we're approaching right now. So if that pattern holds true, we'll see higher dividends from JEPI in the coming months, but no promises. One of the JEPI fund managers, Hamilton, said in an interview this year that he expects JEPI to deliver a yield of 7 to 9%. If we annualize the most recent dividend, the one I just mentioned, it equates to a yield of 7.3%, so I think we're back on track. JEPI isn't supposed to outperform the S&P 500. If that's what you're expecting, then you bought the wrong fund. I expect JEPI to continue delivering yield of 7 to 9%, plus some appreciation over the long term. To anybody considering selling JEPI because the dividends have been lower recently, I understand the sentiment, but I've got 2 questions for you. Over the next 12 months, do you expect volatility to be higher or lower than it is today? And the second question, will a replacement investment, whatever you're going to buy, that yields more than 7 to 9% come with the same or less risk than JEPI? Well, my answers are, number 1, I think the VIX is more likely to go up than down. And for the second question, no, I can't find anything that yields more and has less risk. During the next downturn, I expect JEPI's portfolio will hold up better than the overall market, just like it did in 2022, and that the downturn will come with an increase in volatility and therefore higher dividends for JEPI. In summary, I acknowledge the growth potential of the Magnificent Seven and use other funds like JEPQ that I mentioned earlier to capture income from that growth. But I want to limit my reliance on those 7 stocks, so JEPI is a way to generate income through all market cycles. Before I go, I mostly make videos about investments I like, but I like some more than others. If you want to find the videos that are my favorites, I made a playlist to save you some time. BXSL is the latest addition to that playlist. That wraps it up for this JEPI update. More armchair income coming soon.